Welcome everybody to our webinar today on financing options for profitable deals in 2024. My name is Brad Uhlig. Have my business partner Jay Peterson here with us today, as well as two guest speakers, Brandon Rogers with Parkhill Finance and Kevin Kostoff with Guardian Mortgage. Sorry, guys. Just before we get started, just a little quick blurb on what we do here at West Peak Properties. For those that don't already know, we are a full service brokerage company specializing in investment properties ranging from a single family rental property to larger 4, 6, 8, 12 unit apartment buildings. We can help you buy it, sell it, manage it, 1031 exchange it. We have an extensive network of contractors, so if you need to have work done on it, etc., we can help you fix it, all that good stuff. So our mission basically is to help you create cash flow and build wealth through investing in real estate. We've been doing this since 2009, and I guess, Jay, that makes it 15 years now. And we do have an extensive network of investors. I'd say our network list is about 5,000 people strong at this point. And because of that, about 20% of our transactions every year are conducted off market. So if you have a property you want to sell, or if you're looking to buy, it's always a good idea to reach out to us first. Some sellers that we encounter just don't want to market these things in the traditional way, etc. So feel free to reach out to us with those types of needs. We don't do property management ourselves. However, we do work with experienced property management companies that we can refer people to. So just a note on that. If you're looking for property management, reach out to us and we can hook you up with a couple of companies that we know and trust and that even manage some of our own properties as well. Again, I'm Brad Uhlig. This is Jay Peterson, my business partner, and this is how to get a hold of us. Feel free to reach out to either one of us, and phone numbers and emails are there. So today, as I mentioned, we have two guest speakers, and we're going to be talking basically about financing. Brandon Rogers is with Parkhill Finance. He is a more what we call a commercial lender. He will lend on properties, multifamily units of 5 units or more. And then we have Kevin Kostoff here with us from Guardian Mortgage, and Kevin is more of a residential lender. He'll do 1 to 4 units, traditional 30-year fixed type products, or there might be some other type stuff that he has, and he can talk about that as well. So we're going to go ahead and let Brandon get started and talk us through the commercial side of things on some of these larger loans, larger buildings. And I guess, Brandon, I'll let you go ahead and get started and introduce yourself and your background, and then probably be a good thing to kick off where we think rates are going to go this year and what rates are doing as a good starting point. So Brandon, appreciate you helping us out today.
Yeah, thanks, Brad, and thanks, Jay. Appreciate the opportunity, and hello to all you out there. So yeah, Brandon Rogers, Parkhill Finance. I grew up here in Denver, so I've been here for a long time. Went to high school here. But I've been doing commercial real estate finance here in Denver since 1998. And so, seeing a lot of change with the real estate market. Most of what I have done has been either multifamily or retail. So obviously we're going to stick with multifamily today. As a side note, I've done, as you can see on the right-hand side there, a lot of other property types, kind of anything else commercial. I've done a little bit of it here or there. While I focus here in the Front Range, I can go nationwide for some deals. So where will rates go? I don't know. I think if people talk about rates coming down this year, I've seen that conversation, that topic kind of come and go. I mean, I don't see a lot of motivation for the Fed to cut rates a whole lot. I mean, if there's still inflation, like you're talking about the soft landing, and the economy is doing pretty well overall. Maybe not our real estate economy isn't rocking and rolling, but nationwide economy is doing pretty well. So I don't see a ton of motivation for the Fed to make any big cuts. I mean, I'm not the best pundit, but my guess is we see a small cut or two later this year, summer, fall, maybe a quarter point to the Fed fund rate, maybe a half point total is my guess. It is also an election year. The things we also can't control are what else is going on in the world. What's going to happen in Ukraine or Gaza or with the EU or Britain or those things can affect some of the interest rates too, and it's impossible to predict what that's going to do. So it's just really hard to know what's really going to happen. I threw this graph in, which really shows if I move my, and you can see where we are today versus where we were the last few years. And today's rates, historically they're not crazy high. They're kind of right in there. Maybe they're a little high, but it's the rates that we got accustomed to over the last 10 years are just abnormal. And so it's really not healthy, I think, to expect to go there, to model going back there. So with the recovery from the recession and of course COVID, just it was a very unique time. So hopefully, if rates are right now in the, call it 6s and 7s, hopefully can kind of get back to the 5s and 6s, which I think would be pretty acceptable. If you look at where rates were in the right before the Great Recession, 06, 5s and 6s where they were at.
And what are we at today? Do we have any kind of ballpark where we're at right now?
So, generally speaking, interest rates today for multifamily kind of in that, let's call it 500,000 to a couple few $1,000,000 is going to range from about 6.5 to 7.25, 7.5%. The rates are, the lenders will, base their interest rate in part on their cost of funds, which can vary from being the 5-year U.S. Treasury, the 10-year U.S. Treasury. It could be prime. It could be the Fed fund rate. It could be SOFR, which has replaced LIBOR. It could be a Federal Home Loan Bank overnight rate. So it really varies. You'll also see rate variations in rates based on loan size, based on leverage. Those are kind of the key factors, I would say.
Gotcha. Okay. Ready?
Yeah, so as I was kind of alluding to there, we have those different types of lenders that have different types of costs. But yeah, I work with banks and credit unions. That could be a small local bank or regional local bank or local credit union or out-of-state credit union who wants to do business here because they like our market. Freddie Mac and Fannie Mae are great sources for apartment loans. They are different from the Freddies and Fannies that do home loans. They do 5 units and up. I'll get into those details. I also work with securitized lenders, aka CMBS lenders, life companies, and debt funds. I don't think those are too relevant for our conversation today because they're typically looking for larger loans, $4 or $5 million and up. Happy to talk about those if anyone wants to give me a email or phone call, but we're going to stick with the first 3 today. So let's start with banks and credit unions. I think these guys are really the players for the smaller stuff. And by smaller, I'm saying $500,000, $1 million, a little bit above $1 million. They're typically more flexible in terms of, maybe they'll be okay with 2 houses and a 3 unit on the same legal or different legals, but operated as a single property. Whereas Fannie or Freddie that might not really fit what they want to do. So it can be more flexible, maybe the collateral type. But I'd say they can also be more rigid. They might also, they want tax returns, they want bank statements. They might have a little bit thicker underwriting file on the borrower that they just have to have for their file. So that's what I mean by they could be more rigid. Banks and credit unions typically have smaller prepays or no prepays. I think a common one is like a 3210, which is called the step down. What that means is, in the first year, the prepayment penalty might be 3% of the loan balance, and it'll go down to 2% the next year, then 1%, then nothing, or no prepayment penalty at all. But prepays they're pretty common in commercial, but there's options without them. I've already kind of covered the wider range in rates because of various cost of funds. Banks and credit, banks for sure, the local banks for sure really prefer local borrowers, not all of them, but most of them, because a lot of times they go to their loan committee and say, well, one of the reasons they feel like they should make a loan is to increase their banking relationship with the client or have more of a potential. So they prefer to have local borrowers. Again, not required, but prefer. Credit unions are a little bit less sensitive than the banks about that. They like it, but it's not as big of a deal. Um, one thing we're seeing a lot of in the last year is we've all heard about banks liquidity issues. And so a lot of banks are saying, hey, we'll do this loan, but bring us some accounts, bring us some deposits.
Mhm.
Some of them will require it. Some of them will incentivize you, and maybe it's a slightly lower rate or something, or some of them will just, some of them don't really bring it up, but they liquidity is an important part of the banking world today. So that topic does come up.
Mhm.
Um, yeah, not all lenders will go under $1 million. I have some that do. I try and only work with a select number of lenders that are easier to work with. I don't like to work with lenders that are a huge pain on some of the smaller loans. Um, it's just life's too short, right? To
Yeah.
um, be run over the coals for smaller loans. Most banks and credit unions require a personal guarantee. Not all of them, but the vast majority. And sometimes that goes away if it's a really low leverage or something like that. But I would generally assume it's going to have a personal guarantee attached to the loan. And syndications, whether that syndication is a key principal and one investor or two investors or five investors, um, that's something to keep in mind. Certain banks and credit unions have certain recourse requirements. It could be as simple as we need anybody with 20% of the ownership to sign the recourse. Some of the credit unions are a little bit more stringent. They'll say anyone with more than 20%, but they also need 50% of the entire ownership to sign on the dotted line. Um, Banks don't usually have that one, but they might just, they'll want anyone with 20% typically. Or if you've got like one really strong person, sometimes they can be okay with that. So that's something to keep in mind if you're going to have partners or investors in your deal, if you're kind of going to slightly bigger deals.
Gotcha. So before we move on, Brandon, I just want to let everybody on the call know that we're happy to answer questions as we go. There's a Q&A box down at the bottom of the screen that you can type in a question, and then Jay will be monitoring that and interrupting if there's questions along the way. So feel free to ask questions of Brandon or Kevin as we go through this.
Freddie Mac. Freddie Mac is a really competitive option in Denver and Boulder. Uh, if technically they say they're $1 million and up, and that's technically true. They just get really weird below 1.5 million because the biggest thing is they just will not do a loan under $1 million, and so they don't want to put a loan under application at 1.2 million and have something weird happen like with the appraisal, and they can only get to $990,000 and they have to kill the deal. So I like to say keep it at 1.5 million, just kind of stay out of that. Really, I'm not saying we wouldn't, but they get really weird down really close to 1 million. Um, they've got good rates. Right now I would say that their rates for a lot of stuff is going to range from that low end of the market. They're going to be the low end. Probably 6.5 to let's call it 6.8. That's going to depend on leverage. It's going to depend on the size of the loan. It's going to depend on the bells and whistles, whether it has interest only or if we kind of pay the prepay down a little bit. But that's kind of where they're at. They're really good in Denver because Denver's what's called a top market. It's one of the cities that Freddie Mac likes a lot. So we get lowest rates, we get the highest leverage, we get interest only, we get all the bells and whistles here in Denver. If you
What
move
what
that,
go ahead. What are they trying to? What are they requiring for down payment?
so it's gonna be that's gonna depend on the cash flow. Most loans are shaking out around, you know, I'm not seeing anything get done above 70% leverage. There's not enough cash flow in most of the loans. I would say 60 to 70% LTV is where most loans are penciling. So that'll kind of depend on the cap rate, of course, too.
So if you got a multifamily deal that's about 2 million, it seems like this is a much better route to go than banks or credit unions in general, right?
Yeah,
Right.
really, yeah, it could, yeah, it really could be, especially if you, because you can get a little bit lower rate. You can easily get 1 year of interest only, which is really nice for your cash flow in that first year. It is non-recourse, which some people it's important, some people it's not. It's really good because if, let's say you've got two or, maybe you've got you and you've got a couple investors, and as long as you meet the recourse requirements, you're the only person that needs to sign the non-recourse paperwork. Your investors don't have to get involved in that, and it's pretty hard to get investors in a deal when you also have to when you also ask them to guarantee the loan. And this one, we call it the syndicator. The key principal. They're not really guaranteeing the loan either. They're only signing what's called a non-recourse carve out, which means if the market turns horrible and through no fault of their own, the property has to go back, the lender can't come after them personally. So there's a lot less risk. Um,
Yeah.
and as I referred to, they're just a buffet of options which can affect pricing, whether it's the prepayment penalty or interest only, things like that. It's small effects on the rate, but it all affects things. And they don't care about the banking relationship, which I was referring to earlier. They're not looking for accounts, they're not looking for deposits. They just want to do a loan.
And then are these like 10-year fixed? Are they variables? How do they work?
Yeah, most people take the 5 year fix, but they can do 5, 7, or 10.
Okay.
It can actually be structured as a balloon or as a hybrid, which then converts to an adjustable rate. Right now, the balloon does have a significantly lower rate, probably about 0.2%. So most people are opting for that. So it can, most people go for the 5 year money because it's the best rate, has the smallest prepay, so it offers best cash flow and the most flexibility.
Gotcha.
And the most proceeds because of the lower rate. When you plug that into the cash flow model, you get a little bit more loan on the 5 year rate too.
Gotcha.
Fannie Mae, again, I'm going to say 2 million and up, but I mean, technically they do go smaller than that, but not on every loan. It really is kind of case by case. It's going to depend on where's it located, what's the quality of the property, what's the experience of the borrower, does the borrower have how likely are they to get other loans? So, and some Fannie lenders just they don't want, even though Fannie Mae says they'll go to 1 million, some of the lenders just are pickier about those loans. So I like to say it's 2 million and up. But if someone said, "Hey, we've got this deal, it's $2.3 million purchase price, probably need 1.5 million," that we should talk about it. That's fine. Fannie actually does have the best rates today. It's interesting because they actually pretty much reality is they pretty much only do 10-year fixed. They say they offer 5 and 7, but no one takes that money. It's just too weird. They changed the cash flow model. They're known for 10-year fixed rates. So it's good for if you have a property that you're confident it's a long-term hold. Again, it's good for the syndication thing because it is long-term hold, it's non-recourse. They've got bigger prepays, and so it's not good for someone who thinks they want to buy a 8-unit today and then sell it in 2 or 3 years and go up to a 15 or 20 unit. It's typically not the best option for that. It can work because the loans are assumable, but you just have to be aware of the kind of the strings attached to the money. They'll also offer the same interest rates, whether it's Denver, Boulder, Pueblo, Greeley, Sioux Falls, Bozeman, Montana. It's all the same rate. And well, I did say, I guess I did say interest rates are actually 6.5 to 7.5. I lied. Fannie Mae could actually be around 6.3% right now on the loan sizes we're talking about. So that's a little better. They're probably kind of at 6.3 to 6.5% range for the type of things we're talking about. So kind of right in there. It's pretty easy to get 1 or 2 years of interest only, again, which is really nice. You just buy a property to kind of get things rolling. and maybe if you replace anything, whatever, just a little bit better cash flow. Like I said, non-recourse, and like Freddie Mac, they're good at syndications because they don't have any requirement where anyone with more than 20% of ownership or a certain percentage of the ownership, as long as you got one good person who meets the recourse requirements, you're good to go. And that really quickly, those recourse requirements are typically net worth that is equal to or greater than the loan amount.
Hmm.
I think it's good to pencil in having 10% of the loan amount in post-closing liquidity, cash equivalents, investment accounts, but not retirement. And then a couple years of experience in a like-sized property. Or maybe it's two properties that add up to the same. If you're increasing, let's say you've had 2 6-units for 5 years and you're going to buy a 12-unit now or something like that. Something like that should work too. So as long as you got one person, or if you got 2 people to add up to meet those requirements, that can work too.
Gotcha.
And these loans are amortized 25 years, 30 years, or?
Sorry, all the apartment loans I'm talking about today will have 30-year amortization.
Okay.
Some banks will try and go 25, but I tell them to go pound sand, or none of my clients will take a 25-year am.
Right.
So I mean, a lot of people ask me, why do these loans? I've got 7 duplexes, and obviously you could sell a few of these duplexes and then consolidate into a 10-unit or something like that. And that way you're not driving all around town to fix a toilet, mow a lawn or whatever. So you can consolidate all into one property to helps with your time. And obviously, economies of scale associated with that. And then, Kevin will speak to this better than I can for sure, but when residential loan versus a commercial loan, but really if you're talking commercial to commercial, as you get to a little bit bigger loan, you get a little bit better, a little bit bigger loan gets a little bit better interest rate oftentimes. And so that's going to help your cash flow as well. So that's kind of what I mean by advantages there. Hopefully that makes sense.
Yeah.
I think that's pretty much it for what I had prepared. Obviously, here's my contact info, and feel free to call me or email me anytime.
All right. Yeah. So are there any questions from the gallery, Jay?
No, I think we've been asking good questions ourselves, so maybe that helps.
Okay. That's good. And so we'll move on to Kevin now. So Kevin's our residential mortgage broker, and he's going to be talking more about the kind of 1 to 4 unit type products that he has available. And one thing I'll say, as we get into the 1 to 4 unit type stuff, every deal that Jay and I have closed over the last 12 months has generally had in that range, in that 1 to 4 unit range, has generally had some sort of seller concession that helps the buyer buy the rate down. So one thing I will say is that the rate is not always the rate when we get into the 1 to 4s. So you might think, oh, I don't want to buy anything, or I don't want to sell anything because I'm not going to be able to make this cash flow, et cetera. Keep in mind that the seller incentives are out there to help buy that rate down. Kevin also will talk about another product that he has where the lender themselves are offering cash back that you could possibly use to buy that rate down, et cetera. So just keep those things in mind. I know people are a little shy right now on deals, but there are ways to make deals work and to make these cash flows profitable for you. So Kevin, I'll let you go ahead and get started on what you do.
Well, Brad, Jay, thanks for having me with you guys today. It's I'm learning a lot from Brandon on the commercial side. That was great. That was some really good intel. So this is going on my 33rd year in mortgage lending. We're here at Guardian Mortgage. We're a division of Sunflower Bank. So we have all the Fannie Mae, Freddie Mac, correspondent type product, but we also have the power of a $7.8 million bank behind us. And actually that just doubled because they just bought another bank out in Seattle. So we have a lot of, what's that?
Home Street.
Yes, yes. So we're now even twice the size we were. So we're really excited about that. The Guardian Mortgage, like I said, is part of Sunflower Bank, 57-year-old bank. We've got a whole wide variety of product lending in-house. We, like I said, have the Fannie Mae, Freddie Mac stuff, but we also have a lot of portfolio type product, cross collateralization, that kind of thing. Everything happens in-house. Our underwriter literally is 2 doors down. We service 96% of our portfolio, lend in 44 states, excuse me. We just recently got rid of a couple because they were just not fun to lend in. So, but we have all the bells and whistles that go along with that. All the basic loans that everybody is pretty much familiar with, the conventional government, all of that. We have all of that, the renovation loans, bank statement as well. But the thing I want to get to is the CRA loans. For those of you who are not familiar with that, that stands for Community Reinvestment Act. Legislation passed several years back now requires banks to keep a balance in their portfolio of the different types of loans in there, whether it's jumbo or lower socioeconomic. And most of the banks out there go out to the secondary market and just buy those products off the street. Sunflowers decided to go a little bit different in that they pushed that down to the loan officer. We as loan officers have up to 2% in most Denver metro areas to give to the buyers of homes in those areas. This is what Brad was talking about. So if you buy a home in Arvada or Aurora that qualifies for CRA, we literally give you 2% to use toward buying down the rate, closing costs, escrows, whatever you choose. Because we need more loans in those areas. It's just that simple. It's not that we're coming up with money and just giving out, bumping up rates to cover it. It is that this is the money we would use to go to the secondary market. We've pushed it down to the street. So this can also be used when you're selling a property. If you are selling a property in a CRA zone, Jay was talking about that earlier. We can help market that rather than you paying an incentive to a buyer. We'll give that 2% again in that same area. These are not limited to primary residents or first-time home buyers or anything like that. It just has to be in a CRA zone. You would be really surprised where CRA zones are. For example, most of downtown Littleton qualifies for a CRA zone. And that is a high investment area right now. So,
and Kevin, is
go
that
ahead, Brad?
two to 4 units also?
That's 2 to 4 units as long as it falls in that CRA zone.
Yeah. Okay.
Yeah, I've seen I've had Kevin take a look at several properties for us, and even in Lakewood, Wheat Ridge, we've had a lot of them that are in those zones. So it's definitely worth exploring. Jay, do we have a question?
Yeah, this is a question for Brandon. We can either do it now or towards the end, but whatever you guys want to do.
Well, let's wait till Kevin's done. We'll
Yeah.
hit it.
Sounds good.
All right, go ahead, Brad.
Yep.
So like I said, we've got all the traditional Fannie Freddie stuff. And this is just for if you're looking to buy a home in the Denver metro area, just using the traditional financing, we have it all. So
This is all like 30-year fixed product we're talking here.
Yeah, this is all 30-year fixed, generic vanilla. We do have some ARM product available, especially when you get into the jumbo areas. And we even offer that CRA at a lesser amount, 1%, on the jumbo product as well. Speaking of jumbo, that's one of the reasons that the bank needs CRA loans so badly, and they are buying them from the consumers, is because they do very well in the jumbo marketplace. We have a jumbo arm that is pricing right now at 6,375, which is pretty much the best on the street that I know of for that product. So we are doing very well, but that is also why we need this CRA stuff. Also, if you'll notice on here, we do look at non-warrantable condos. So if you have a condo project, which right now we're coming across a lot of those, we do look at those on a case-by-case basis.
So what
There's a quick
qualifies
question
it?
here, Kevin. Is there a list of CRA zones in Metro Denver?
It's a website. It's actually the census website that comes out every year. You have to look at the 2023 census. I'm happy to send a link to anybody. They can look it up real quick. It takes all of 2 seconds. And then the property has to be listed as either low or moderate in that census zone.
Okay. Yeah,
Brad, you had a question?
Yeah, so what qualifies as a jumbo loan? Did that change recently?
It has changed, and it's going to go up. It went up in January. It's very county specific. Basically, anything over 800, give us a call. We'll talk to you where you're going to be at.
Okay, and you said that rate for a jumbo was what?
That arm is at 6.375 right now.
Nice. Okay.
We do have a lot of investment property financing available in-house and through Fannie Freddie as well. But we do have portfolio products that we look at. Earlier I talked about bank statement. We do even have one that is property specific qualifications. So we look at the cash flow of the property. If it pays for itself, we can do a loan for it. Specialty programs, that was the some of the community reinvestment stuff we were talking about, also about the portfolio products that we have in-house, the bank statement programs. They're not limiting, the rates on these are not actually all that much different than if you were to do a Fannie Mae or Freddie Mac type product. And in some cases, we find they're actually better with all the overlays that Fannie and Freddie tend to put on. We typically will see that a lot of these programs will price out better.
So this one here, it's just talking about DSCR loan. How is that different
Yep, this is the debt service that I was bringing up earlier. This is where basically the property itself is paying for it. If the cash flow pays for it, that's all we're looking at. We're not qualifying the borrower. We're not looking at your personal finances in a lot of cases. We're not looking at tax returns. We're just strictly looking at the property.
And how much higher of a rate usually is this kind of a loan over Fannie Mae?
This one really is dependent on how much you're putting down. With a 25%, 30% down, you're not too far off from Fannie Mae, Freddie Mac. I would guess you're probably 7.5, where today it was Fannie was at 7 1/8.
And on the other products, are there lower down payment requirements?
Pretty much the lowest we have right now is 20% down on an investment property. 25% is where the pricing starts getting more attractive.
And
Does that answer your question, Brad?
yeah, for sure. And are people paying a bump as an investment property versus a primary residence?
Oh, for sure. Yeah. Fannie Mae and Freddie Mac have their overlays that they add on for every layer, what they call layers of risk. And investment property would definitely be considered a layer of risk. And when that's why the pricing improves so much with 25% down versus 20, they believe that one of their layers of risk goes away.
Gotcha. Makes sense.
Again, the bank statement qualifier, we can do a bank statement program. We look at your 12 months of bank statements to determine the income. Asset qualifiers, that's more of a portfolio product that we look at. We look at your banking, that kind of thing. That is an in-house product. Then the traditional 30-year fixed, that's the Fannie Mae, Freddie Mac. We do the primary, second home, investment properties, all of that type of product. And then loan amounts from 50,000 all the way up to 2.5. And then, and that's pretty much where Brandon wants to start from what I understand. So, feeling I've got a little loan envy there, Brandon. And then 720 plus credit scores is what I'm putting most of this off of. That's basically one of the biggest factors that I can't emphasize enough, especially in the investment world, is that they really, really look at the credit scores. Anything under 720, they're not even going to it's going to become very difficult to find investment financing. And then again, we do look at non-warrantables on a case by case, and we're available in all 43.
Any questions, Jay?
Next.
Yeah, Kevin, you do loans for Oklahoma. This gentleman has a self-finance renovation flip that needs to be financed as a rental home.
Yes, we do. We do Oklahoma without any difficulty. Relationship loans. That's what I was saying. It's another way of saying we have portfolio product. We are looking for a relationship within the bank. You put money on deposit in one of our, I think on Friday I was looking, our money market was paying 4.75, and you put on 100,000 in there, and we'll drop the rate. Sometimes I've seen up to a half point in dropping the rate on that. So it's definitely a case by case basis. This is something that we're happy to talk to you about if you've got a project or you're looking to get specialty like the gentleman in Oklahoma. If he needed it, we could look at something like that as well. Next. So I briefly mentioned this earlier, that 2%, up to 2% incentive that we have on the CRA. If your property is in a CRA zone, you can offer that as an incentive too, and use that to buy down the buyer's rate and not use your funds as well. So we have it available on both ends. As long as the property is in a CRA zone, anytime it's financed, the 2% is available to it. And it doesn't matter who it's for. We can just, even if you refinance it, we can use the 2% again. They just have to keep zoning it as a CRA, and we're good to go. So,
Gotcha. So if I'm an owner and I'm looking to sell, I don't want to have to give up $10,000 to $20,000 as a seller concession to help the buyer buy the rate down. I can offer this through you as long as the buyer.
You can have them. Have them call me. As long as the property's in a CRA zone, we'll give them 2%. We'll buy down the rate with that.
Right. So as long as the buyer uses Guardian Mortgage for their loan, then they would get that.
Right.
Gotcha. Okay.
Right. The distinction too on the rate buy down, Kevin, this is a permanent rate buy down, not just a 2-1 or a 1-1, right?
Correct. Well, it's your choice. You can do a permanent, you can do a temporary, you can just pay closing costs. We just did one up in Sunnyside. It was a investor flip. The gentleman, we had close to $17,000. We were coming up with all kinds of inventive ways to use that money. We ended up closing early just so that prepaying some interest to use it all.
And just to be clear, it's 2% of the loan amount, not 2% of the purchase price, right?
That is correct, and I appreciate that, Brad, because it's very county dependent. It's up to 2%. The reason I say up to 2% is that it's in Denver Metro. It's up to 2%. For example, you get down to Pueblo, and it's 0.75%. I think Weld County is also 0.75%. But the Denver Metro area is up to 2%.
Gotcha. Okay.
And there's my contact information. I'd love to discuss any scenarios. The gentleman with the Oklahoma property, I'm happy to discuss that. If you just want to reach out to get that link for the CRA, just shoot me an email. I'll shoot you that link right back. Or if you want me to look it up for you, I can look it up. It takes all of like 2 seconds.
Jay, do we have any other questions? Do we have?
Yeah, one for Brandon. And you mentioned this a little earlier, Brandon. This gentleman, Brian's asking, what's the minimum loan size that offers better rates?
It really, I think $1 million is a good number to pencil in for that, but it really does vary from lender to lender. And you know, like Freddie Mac, for instance, while technically they will do $1 million loan, the rate will get better. It will just scale up as you go up 1 million, 2 million, 3 million. But you know, there are a number of lenders that just don't want to go below $1 million. So that's why I have a kind of a limited number of lenders for that. So there isn't really a magic number where all of a sudden the sun comes out and everything's better. It's just kind of a sliding scale, frankly.
Yeah. Well, it sounded like Freddie and Fannie were your best options for rates and terms. It's just you got to be at about $1.5 million or higher.
Yeah, I mean, again, technically it's $1 million. They're just if your property only if you think your property only qualifies for $1 million, there's no room for anything to not appraise exactly right or something like that. So because it has to end up at $1 million, and so it's nice to go in with a little bit of a cushion, I guess.
It has to end up, it has to end up at $1 million as a loan amount, right?
Yeah.
So if you go through the negotiation process on your property and you negotiate the price down, and then the loan amount doesn't end up getting to $1 million, then that's where they get nervous. Like
yeah, because then they're like, we're out. You know, we're just not doing it. And so, you know, Fannie and Freddie are pretty. You know, they do the same thing over and over and over every day. And I work with experienced Fannie and Freddie lenders, and they know how to size up a deal. So they're really pretty good about putting the stuff in the model, figuring out where it's going to price out. You know, Freddie locks the rate in the beginning of the process. Fannie Mae doesn't lock the rate till the end of the process. So and there's the appraisal, and most appraisals are coming in fine these days. I think the last apartment deal I did, which was a little 8-unit in January, that actually appraised for 10,000 higher than the purchase price. So they, you know, technically it's $1 million and up. Just it's nice to be a little bit above that, so there's some fudge factor room. But like I said, I've got banks that'll do 500,000. I actually closed a $300,000 loan on a industrial warehouse for a guy back in December. He wanted to keep his boat in there, and I think some ATVs, maybe a snowmobile. He just kept his toys in there. So that was a really small loan.
Right.
So anyway,
Gotcha.
it's all case by case.
Yeah. Kevin, we have a question from Annette. She's asking, we need to refinance a small fourplex in Fountain, and due to 1031 constraints, we were forced to get hard money. Would you consider that a CRA zone, or do you know if it is?
Fountain is a high likelihood, but I would definitely have her just shoot me the address, and like I said, I can look it up in 2 seconds and tell you yay or nay.
There's Kevin's contact info again.
Sounds good.
And we will be sending the recording of this out to everybody that attended and everybody that registered. So you'll get all that information as well. Probably be tomorrow before you can get it out, but we'll get it out to everybody tomorrow. Jay, any other questions?
No, I guess I'll make a comment that some of the properties that I financed, Brad and I financed together on a couple of our deals is, for those that are not familiar with portfolio loans versus Fannie Freddie, is that the reason to do portfolio is that you can buy the property in the name of an LLC, which is that hedge layer of protection. And so there's the advantage of doing that with portfolio, which Kevin does offer, he said. So just to clarify that.
Correct. Most of the traditional 30-year fixed product, you'll have to buy it in your personal name.
Right.
Yeah, for sure. Well, hey, I wanted to thank Brandon and Kevin for joining us today. Thanks a lot, guys. Really appreciate it.
Thank you.
Hope
Thank
everybody
you.
found this of great value. And again, we will send this out to everybody that registered. And thanks for joining, and everybody have a great day.